Let's get serious, Raul. Let's talk about money. Let's talk about cash flow, about net operating income, not the numbers brokers put on a pro forma brochure, the numbers that actually hit your bank account. Let's talk about that, Raul, because in this 2026, the biggest threat to your ROI in Miami isn't interest rates. It isn't a market crash. Unfortunately, it's insurance.
Yeah, that's right, Andres. We are living in a new reality called FEMA, FEMA risk rating 2.0. The days of subsidized cheap flood insurance are over. If you don't understand how to calculate your glide path of insurance premiums, you're going to buy an asset that bleeds you dry.
Yeah, Raul. Let's talk about let's dissect the insurance crisis because for for many people, the citizens property insurance cap has been something to talk about, and we're going to show you exactly where to invest to avoid this volatility entirely, and we can call it a turnkey cash flow strategy.
Yes, the new math is the risk rating 2.0. What is a risk rating 2.0? Simply put, it's FEMA charging you for the true actuarial risk of your property. No more cross subsidized. If you're near the water, you pay for it now. To prevent total economic collapse, they created the glide path by law. They can only raise your premium by 18% per year. That sounds manageable, right? Wrong. 18% compounded means your insurance bill double in 4 years.
Raul, 18% is crazy.
It's too much.
I mean, 80%. And here's the secret that most agents won't tell you. When you buy a property in 2026, you inherited that glide path. You aren't just buying the property, you're buying the trajectory of future cost increases. And you need to know what the full risk rate is. If the current owner pays, let's say, $4,000, but the full risk rate is $12,000, you're walking into a financial trap and it's going to be a nightmare.
That's right, Andres. And also consider citizens property insurance. The insurer of last resort in
Yeah.
2026, the statutory cap on rate increase is 15%. That means
Wow.
your best case scenario is a 15% increase in cost next year. If your rent only goes up to 3%, but your insurance goes up to 15%, your profit margin just evaporate.
Well, Raul, just imagine that 15%. I mean, let's look at the projections because from the 2026 report for a coastal property, say, let's say Miami Beach or Key Biscayne, even in a good year, you're looking at an insurance cost of sometimes $7,000, $10,000 annually for a standard unit. If we get a storm, a hurricane, that number could go up very quickly. And this creates a massive drag of net operating income, what we call NOI. And it makes it very hard to cash flow on the coast unless you're doing luxury short term rentals with very high revenue.
So, where does the smart money go? Where do you find safety? What's the solution?
The solution, Raul. Well, the solution is to decouple your investment from the coastal risk. We are recommending, let's say, a pivot to inland single family and townhouse or townhome markets. Areas like, and this is more inland, of course, we talk about Hialeah, that's in the middle of the county, Miami Gardens, Doral. Well, yeah, Doral is on the west side, it's pretty cool. So you have to evaluate other areas, not necessarily what you see on Instagram or on TikTok or on YouTube. Take a look at other cities or zip codes.
Yeah, why? First, they are farther away from the flood zones. The insurance premiums are drastically lower. The risk rating is favorable.
Yeah.
Second, single family homes do not have SIRS mandates. You don't have a condo board telling you to put a 50,000 in your reserve account. You control your maintenance, you control your roof, you control your destiny. In
Yeah.
2026, we are seeing a flight to simplicity. Townhouses built after 2010 are the sweet spot. They are
Mhm.
insurable, they have lower HOA fees, and the demand for them is skyrocketing because the condo market is becoming too expensive for the average tenant.
Yeah. And what if we talk about the turnkey strategy, Raul? Because i- if you plan to buy a 3 bedroom townhouse in a western suburb, right? Your insurance is going to be stable. Your taxes are predictable. Your tenant demand is high because the workforce really needs housing. For some
Mhm.
people, it's boring, but boring is exactly what you want in your portfolio when the cost is unpredictable.
Yes, Andres, and while everyone else is stressing about a special assessment and 18% insurance hikes on the beach, you are collecting rent checks. It's the difference between investing for ego, the view, and investing for profit, the bank account.
Yeah, definitely. So you have to think about where you're going to put your money. And as for the full risk rate on the floor insurance, not just the current premium. You should look west of South Beach. You should look west of Edgewater. You should look west of Brickell. You should look west of Aventura. And don't let the insurance crisis catch you off guard because you have to calculate the true cost of ownership. You have to be smart. You have to know the market. If you have questions, remember to subscribe to Miami Real Group and to share all our videos with your friends and family.